Hello, I'm John A.G., and on Friday something happened that didn't announce itself the way important things usually do. There was no dramatic headline, no flashing alert, just a quiet number update that landed while I was distracted, half focused on something else, and that's what made it unsettling. I caught myself stopping mid-movement, phone in my hand, staring at the screen longer than logic justified, not because I didn't understand the number, but because I did. And once you see it clearly, it's very hard to unsee what it implies. I wasn't planning to talk about this yet. In fact, I was trying to leave the house. But there's a specific kind of market signal that forces a pause, not because it screams danger, but because everyone around it is acting like nothing happened. That disconnect is usually where the real story lives. And what came out of Shanghai this week sits squarely in that category. People are already waving it off as normal mechanics, routine movement, just another data point. But markets don't usually drain 60 tons of silver overnight without leaving fingerprints. Let's slow this down and start with what actually happened, stripped of interpretation. On Friday, the reported silver inventory, held within the primary Shanghai Futures Exchange warehouse system, fell to just under 350 metric tons. The previous day, that figure was slightly above 400 tons. That's a decline of roughly 60 tons in essentially one reporting interval. Not spread out, not gradual, a sharp step lower. And if your instinct is to say warehouse numbers change all the time, you're right. Most of the time, they mean very little. That's why context matters more than the number itself. At the same moment this inventory drop appeared, silver inside China was trading at a meaningful premium to Western benchmarks, not a trivial difference you can dismiss as noise. The spread expanded into territory that makes people uncomfortable when they actually think about it. Depending on the day and the specific product, the gap pushed well beyond $10 and at times approached $20. That's not just a pricing quirk. That's two markets disagreeing loudly about value. And when that happens, the disagreement doesn't last forever. Either demand fades or metal moves. Before anyone jumps to conclusions, it's important to understand how China's metals market actually functions. This is not a fringe exchange. It's a large liquid system with contracts that can be physically delivered. That detail changes everything. Physical deliverability means the warehouse network isn't symbolic. It's operational. It's part of the contract's credibility. In Western markets, many participants are comfortable owning exposure rather than metal. Futures, funds, derivatives, all designed to track price without touching bars. That works until confidence shifts. China, culturally and structurally, tends to place more emphasis on physical settlement, even if it's not universal or perfect. That's why a premium in China can't be brushed off automatically. The next question becomes whether that premium reflects genuine physical demand or whether it's being distorted by local market mechanics. And here's where things get complicated, because China's market structure is not frictionless. Daily price limits exist. When volatility accelerates, prices can hit those limits and stop. Trading slows. Sometimes it pauses entirely. Participants can get trapped, and trapped markets behave in strange ways. Recently, silver-linked products in China have repeatedly slammed into these daily limits. In at least one instance, trading was halted because pricing became so disconnected from reference levels. That matters. It tells you the system itself was under strain. This wasn't just fundamentals expressing themselves smoothly. It was structure bending under pressure. Now bring that warehouse number back into the picture. A 60-ton drawdown in a single window isn't something you casually explain away. Even if part of the move reflects reclassification rather than physical export, metal still changed status. It moved from one category to another. And that only happens when someone wants it positioned differently. If this were purely speculative excess, most of the action would stay on screens. Leverage trades don't require forklifts. That's why physical inventory moving quickly raises eyebrows. Speed is a tell. Warehouse reports usually drift. They don't jump unless something deliberate is happening. That something could be many participants pulling modest amounts. It could be one large participant pulling a lot, or it could be the exchange changing what qualifies as available inventory. Not all warehouse metal is equal. Some is registered for delivery, some is eligible but encumbered. Sometimes the biggest change is administrative rather than physical. That's why this number is a warning light, not a diagnosis. The nuance matters because of what it implies about trust. If metal is moving out of exchange warehouses into private storage, the market can feel tighter even if total national supply hasn't changed much. That's not a supply crisis. That's a confidence shift. And confidence shifts move markets faster than shortages. When manufacturers stop trusting that metal will be easily available when needed, they change behavior. They order earlier, they oversecure, they stop optimizing inventories. That behavior alone can turn a balanced market into a scramble. Local premiums amplify that effect. A premium can reflect demand, but it can also reflect friction. Taxes, financing costs, capital controls, and arbitrage barriers all play roles. Just because a spread exists doesn't mean it can be easily closed. Still, a persistent premium acts like a stress map. It shows where pressure is building, even if it doesn't explain every cause. That's why both extreme takes miss the point. Declaring a global silver shortage is lazy. Dismissing the premium as irrelevant is equally lazy. Persistent dislocations change incentives, and incentives change flows. Volatility ties everything together. Recently, silver experienced a sharp decline in the mid-teens percentage range, followed by a rebound that looked orderly on charts. That's often narrated as panic and relief, but structurally, it looks like forced deleveraging. Margins rise. Funding costs increase. Traders who can't meet requirements are pushed out. Beliefs don't matter. Cash does. And in a thin market, that process produces violent moves. Here's the counterintuitive part. Forced deleveraging can increase physical tightness. When paper longs are flushed and prices dip, physical buyers step in quietly. They don't care about intraday swings. Paper volume drops while real-world demand rises. That's exactly how inventories can draw down, even while headlines scream collapse. And that brings us right back to Shanghai, because what we're seeing there sits at the intersection of all these forces. To understand whether what we just witnessed was a momentary jolt or the early stage of something more durable, you have to ignore the commentary and watch behavior. Markets explain themselves backward. After price moves, stories appear to make those moves feel inevitable. But price itself responds only to pressure, constraints, and incentives. Right now, those pressures are not showing up in headlines. They are showing up in participation, positioning, and the places where structure starts to creak. One of the most overlooked elements in this episode is who has been trading. Over the past several weeks, silver activity across parts of Asia has taken on a distinctly speculative character. Volume surged rapidly. Price swings accelerated. You could see the fingerprints of retail-style behavior in the way contracts moved, the way momentum fed on itself, and the way products briefly traded at prices that only made sense if everyone assumed someone else would pay more later. This kind of behavior isn't unique to silver, but silver's relatively small size magnifies its effects. When large amounts of new money rush into a thin market, price discovery breaks down. Participants chase moves instead of evaluating value. When price stalls, they panic. Then they chase again. Under normal conditions, markets absorb this behavior through liquidity. Under daily limit rules, they don't. Prices hit ceilings or floors and simply stop. Exits disappear. Traders are forced to hold positions they didn't intend to hold. That's when frustration turns into narrative, and narrative looks for someone to blame. This is where the story about a massive short position gained traction. In chaotic markets, large, disciplined players often become symbols of everything the crowd doesn't understand. But large shorts exist for many reasons. Some are directional bets, some hedge physical metal held elsewhere, some are part of spread strategies that have nothing to do with outright price direction. Markets are not moral systems. They are accounting systems. A position that looks sinister in isolation may be entirely neutral in context. So when talk emerges about scrutiny or investigation, the key question isn't whether someone did something wrong. It's whether that scrutiny changes incentives. If it does, behavior changes immediately. Risk managers don't wait for outcomes. If a position becomes politically sensitive, exposure is reduced. That alone can tighten markets not because of guilt, but because of math. If scrutiny is merely symbolic, the market tends to move on, because the underlying flows remain intact. This distinction matters because it determines how stress resolves. Real enforcement actions compress risk quickly. Symbolic actions relieve pressure emotionally while leaving structure unchanged. The difference shows up not in speeches, but in data. Open interest, inventory movement, and pricing behavior reveal which path the market is on. Open interest deserves attention here, even if it feels technical. If positions are being closed broadly while inventories stabilize, that suggests the system is shedding risk. Stress is being released. If positions remain elevated while physical stocks continue to fall, risk is accumulating. That's when markets appear calm just before they aren't. At the moment, signals remain mixed, which is exactly why certainty is dangerous. Another layer that complicates interpretation is silver's dual role. Silver is pulled by factories and by fear. On one side, industrial demand continues to rise, driven by infrastructure, electronics, and energy systems that rely on conductivity. Solar deployment alone has created a steady structural draw that doesn't vanish because charts look ugly. On the other side, silver functions as a monetary asset during periods of uncertainty. When confidence in currencies weakens, when rates feel unstable, when geopolitical risks rise, silver attracts capital seeking something tangible. Right now, both forces are active. Industrial demand hasn't gone away. It has been climbing for structural reasons, not speculative ones. At the same time, speculative participation has been intense and fragile. That combination produces exactly the kind of market we're seeing: violent drops, sharp rebounds, and signals that seem contradictory depending on which lens you use. This is why the question of what's driving China is central. If the premium and inventory draw reflect genuine industrial pull, they won't fade quickly. Manufacturers don't pause demand because volatility makes traders uncomfortable. They secure supply when they perceive risk. If the move reflects speculative excess interacting with rigid market structure, the premium will collapse once participants retreat. And if it's both, the outcome is the most frustrating scenario. Prolonged volatility, sideways action, and sudden spikes that make everyone feel late. The next several sessions matter because behavior reveals intent faster than commentary. If reported inventories in Shanghai continue to decline, even gradually, that suggests sustained physical demand within the system. If they stabilize rapidly, the shock narrative loses credibility. If premiums remain stubborn even as volatility cools, friction remains unresolved. If premiums mean revert aggressively, stress was temporary. Another underappreciated factor is sourcing. If China continues drawing down internal inventories, replacement metal must come from somewhere. Silver supply doesn't respond quickly to price. A significant portion of global production is a byproduct of other mining activities. That makes supply inherently sluggish. Recycling helps, but it cannot scale instantly. Persistent demand therefore competes for existing flows, and competition is what ultimately moves prices. At the same time, expectations need to be managed. Not every stress episode ends explosively. Markets can digest imbalance slowly. Silver could spend time oscillating within a wide range, frustrating both optimists and pessimists. For most investors, that range would feel enormous. For seasoned silver participants, it would feel familiar. These periods often rebuild leverage quietly, shifting positions from weak hands to strong ones while attention fades. What breaks that balance is often external. A regulatory tweak, a margin change, a subtle policy signal, or a macro shock can shift incentives abruptly. Silver doesn't need its own crisis. It often reacts to stress elsewhere. That's why broader conditions matter, even when the focus appears narrow. The current macro backdrop is not calm. Government borrowing remains heavy. Interest rate expectations are unsettled. Geopolitical risk persists. Commodity supply chains have already demonstrated fragility in recent years. In this environment, metals that straddle industrial and monetary roles remain sensitive. Silver, because of its size, magnifies that sensitivity. Small shifts in behavior can produce disproportionate outcomes. None of this guarantees direction. Markets punish certainty. A rapid collapse in premiums would change the story completely. A swift rebuild of inventory would neutralize concern. A reversal in speculative appetite could drain momentum. That's why discipline matters. Observation beats conviction at this stage. The most telling aspect of this episode may be the emotional imprint it leaves. Participants who experience sharp gains or losses adjust behavior going forward. Some become cautious, some become aggressive. Emotional memory shapes liquidity. Markets remember pain through positioning. That's why post-volatility periods often look quieter than expected before reigniting. This sets the stage for the final layer of analysis. Once you understand the mechanics, participation, and incentives, the last step is deciding which signals deserve attention and which ones are designed to distract. Because silver's reputation for chaos often hides a very simple truth. The most important information is usually the least dramatic. The final mistake people make in moments like this is assuming that more information automatically leads to better decisions. In reality, the opposite is usually true. When markets become noisy, clarity comes from subtraction, not addition. The discipline now is deciding which signals genuinely constrain behavior and which ones merely decorate the narrative. Silver has a long history of confusing people precisely because it offers too many stories at once. At its core, this entire episode revolves around physical credibility. Shanghai's warehouse system is not theoretical. It exists to support delivery in a market where contracts can, at least in principle, end in metal-changing hands. When reported inventory drops sharply, even if part of that change reflects reclassification, perception shifts immediately. And perception is not a soft variable, it drives planning. A buyer who believes supply could tighten does not wait for confirmation. They secure material earlier. A trader who believes delivery risk is rising demands compensation to remain short. These adjustments feed on themselves. Persistence is the next filter. One sharp inventory move can be dismissed. Two invite debate. A sequence forces adaptation. Markets are not reactive to isolated events. They respond to patterns. That's why the question isn't whether the Shanghai draw happened, but whether it continues. Stabilization would suggest the system absorbed stress. Continued drawdowns would suggest that something structural remains unresolved. The difference between those outcomes determines whether tension dissipates quietly or compounds. The pricing gap is the third critical variable, not the exact dollar amount, but how it behaves over time. Premiums that appear during chaos and then fade indicate flexibility. Premiums that linger indicate resistance. That resistance can come from policy, logistics, financing constraints, or simple unwillingness to sell. Regardless of cause, a persistent gap applies pressure to inventories already located in the higher-priced region. That's how internal stocks get depleted without a single dramatic headline. This is where the conversation about large short positions becomes relevant again, but only in a practical sense. A short position is not inherently dangerous. It becomes dangerous when exit options narrow. In a physically deliverable market, shrinking visible inventory changes risk calculus. Even if delivery is unlikely, the possibility forces repricing. Markets anticipate stress before it manifests. That anticipation shows up as volatility, premium expansion, and sudden dislocations. At the same time, restraint matters. Silver markets often resolve tension without spectacle. One plausible outcome remains prolonged digestion. Prices could move sideways within a wide range, exhausting attention while leverage quietly rebuilds. To most observers, that looks like indecision. In reality, it is repair. Positions migrate from participants who cannot tolerate volatility to those who can. Complacency returns. Historically, that's where larger moves are prepared, not announced. Disruption usually arrives from outside the immediate story. A regulatory adjustment, a change in margin policy, or a subtle shift in official language can alter incentives quickly. Macro developments matter just as much. Silver does not need its own catalyst. It often responds to stress elsewhere, whether in currencies, rates, or geopolitics. That sensitivity is a feature, not a flaw, but it demands humility from anyone trying to time it. The broader backdrop remains unsettled. Government borrowing pressures persist. Interest rate expectations continue to shift. Geopolitical uncertainty has not been resolved. Commodity supply chains have already shown their vulnerability in recent years. In that environment, assets that straddle industrial utility and monetary signaling remain exposed to abrupt revaluation. Silver's smaller market size amplifies those dynamics. None of this implies inevitability. Markets are adaptive systems. A sudden collapse in premiums would neutralize much of the current tension. A rapid rebuild of warehouse inventory would cool concern. A retreat in speculative participation could drain momentum. That's why the correct posture here is observation, not prediction. Awareness protects better than conviction. What deserves attention over the coming days is simple. First, inventory behavior. Not just one print, but the direction of travel. Second, volatility structure. Are limits still being tested, or is trading normalizing? Third, official language. Phrases about abnormal trading or market order often precede intervention. Intervention does not always suppress price. Sometimes it accelerates repositioning. Fourth, sentiment. When consensus forms too quickly, it is usually early or wrong. There is also a human layer that statistics don't capture. Participants who experience sharp gains or losses adjust behavior long after prices stabilize. Some become cautious. Others become emboldened. Emotional memory shapes liquidity. Markets remember pain through positioning. That is why post-volatility phases often feel eerily quiet before reawakening. Supply realities deserve one final clarification. Silver production does not respond instantly to price signals. Much of it is tied to base metal mining. Higher prices do not immediately bring new ounces to market. Recycling provides some flexibility, but it is not a tap that can be opened on demand. Industrial users do not wait patiently for charts to look friendly. They secure inputs when risk appears. That makes sustained demand harder to satisfy discreetly. Still, not every drawdown leads to crisis. Not every premium becomes a squeeze. Markets have multiple paths to resolution. The danger lies in assuming adaptation is effortless. It is not. Each adjustment leaves traces in pricing, inventory, and behavior. Those traces are what careful observers follow instead of chasing headlines. This entire episode reinforces a simple lesson. The most important market signals are rarely loud. They arrive as small numbers changing in unglamorous reports, technical footnotes that few people read, and quiet shifts in behavior that only become obvious later. By the time price reacts dramatically, the groundwork has already been laid. So where does that leave you? It leaves you watching, not reacting. Watching physical availability, watching whether gaps heal or persist, watching whether leverage rebuilds or retreats, and resisting the urge to anchor to a single story too early. Silver has a long history of punishing certainty and rewarding patience. There is no directive embedded here, only context. If the Shanghai inventory draw proves durable, implications will unfold through sourcing pressure and pricing adjustments over time. If it fades, it will still stand as a reminder of how quickly assumptions can be challenged when structure and sentiment collide. The cleanest summary is this. A sharp drawdown in reported silver stocks occurred alongside elevated local pricing and heightened volatility. Together, those conditions reveal stress. Stress is where markets become unstable, occasionally generous, and often misunderstood. What happens next depends on whether that stress is absorbed quietly or amplified by behavior. For now, awareness is the advantage. Watching the boring data, ignoring the noise, and remembering that silver has always moved fastest when confidence is misplaced and patience is in short supply.